I am very pleased to be able to welcome my colleague, Jeremy Johnson. Jeremy is a director in quantum sister business InTax, a specialist tax inquiries and investigations firm, and also a fellow K3 Capital Group member. Jeremy is a former senior Hmrc inspector, having worked in specialist investigations, otherwise known today as FIS. Today, he works with a very wide range of clients and assists them with a range of disclosures and disputes. He also takes on a lead on cases involving fraud, and he also assists clients in litigating technical tax matters. Jeremy, welcome. Over to you.
Good morning, Marie. Thank you for the introduction, and good morning, everybody. I'm going to rattle through 4 things today where Hmrc seems to be taking a bit of an interest at the moment. So I'm going to talk about crypto assets, reporting residential capital gains on residential property sales, furlough claims. Obviously, furlough is finished, but issues with past claims, and also employment taxes. So the first of those, crypto assets. I read a brief history of time once by Stephen Hawking, and I don't think I ever felt so dense in my life. And when somebody tries to explain blockchain to me, I kind of feel the same way. But whether or not you understand blockchain, Hmrc, and whether or not Hmrc understands blockchain, they certainly understand that crypto assets are out there. People are buying them, selling them, making money, various things, whether it's Bitcoin or NFTs or whatever. Hmrc has recently been sending nudge letters to people, in fact, saying, have you made a gain or a profit on some kind of crypto asset, and should you be reporting that? How does Hmrc know that? I think in the past, the exchanges and the places that you would buy and sell Bitcoin were probably less public, but the exchanges are now certainly more public. And you can be very sure that Hmrc has been contacting the various exchanges to see if it can get information from those platforms to understand, who's been buying what, who's been selling what, are there profits, matching it up against people's self-assessment returns, are there things missing? So Hmrc is certainly aware of some transactions and is only likely to become aware of more transactions. But from a tax perspective, what does a transaction mean in terms of a crypto asset? And Hmrc has a manual devoted to it. For individuals, for most individuals, if you sell a crypto asset and make a profit, it's likely to be a capital gain. You'll need to put it on your self-assessment return. For a very few people who do nothing but buy and sell crypto assets, it could be trade, so it could be trading income. For companies, it could be either as well. If it's something that's been bought and held, it may have to turn up on the company tax return as a capital gain. If a company is involved in buying and selling crypto assets all the time, again, it could be trade, it could be trading income. So it is taxable, it is reportable. There are a couple of nuances as well. If a company wishes to pay employees using crypto assets, then just like paying them in sterling, the company's going to have to operate pay as you earn on that. And similarly, if a company or a trader sells goods and takes payment in crypto assets, there's nothing that changes that payment into something that isn't taxable. Still taxable. You'd have to convert it into the pound value at the time of the transaction, and you've got to report that transaction. So if you've got clients who are kind of touching into the world of crypto assets, whether it's buying for investment or taking payments, it is just like any other kind of money or investment gain, and it should be reported. It's probably worth reminding clients to think about that. And there's also probably quite a lot of people who perhaps haven't invested in other things, but maybe dip their toe in the water with crypto assets, and they find themselves with nicely a profit in some cases. The sale of residential properties, capital gains, and this is in relation to individuals. The rules changed a little while ago, so there's 2 things I want to touch upon here. One is a reminder of the rules about reporting, and another is our experience of the administration of that. So firstly, if an individual sells a residential property that isn't their personal residence, a second property, and makes a profit on that, now it was 30 days, but after the 27th of October 2021, within 60 days, the individual has to report and pay the capital gains on that. So previously it would go in your self-assessment return in whichever year self-assessment return, but now 60 days after the transaction completes, needs to be reported, and the capital gains needs to be paid. And then it also needs to go in the self-assessment return later. But the point to remember is the administration of this, in our experience, is not that easy. So an individual, as well as having a government gateway account, will need to register separately also for a property account on which they can report that. If they've got an agent, the agent will need to go through the various permissions in order to report that for them. Our experience of that, and it could be why it's now moved to 60 days rather than 30 days, our experience of HMRC's administration of getting the permissions is it can take more than 30 days. So if you have a client who's selling a property, get them on the case very early to make sure that they've got their various codes and accesses and permissions to deal with that. So that's residential property gains. Moving on to furlough. Furlough's finished. As Frank was saying, financial institutions are looking back at businesses and, what was the impact of COVID on that business. HMRC is also looking back at furlough claims. About £66 million worth of various support packages was paid. It was estimated about 5 to 10% of that was error or fraud, probably. So £6–7 billion perhaps of problems out there. HMRC is quite interested in that. 1,200 people or so who are dealing with that and looking at those issues. Some matters have been taken up criminally where it's been a fraud. But what are the impacts of an error in a past furlough claim? What should people be doing? And errors could come about a number of ways. It could be deliberate, it could be careless, or it could be people did their best, but the rules changed and they were fairly complex and mistakes were made. Legislation, HMRC has legislation that effectively turns an overpayment into tax. So if there is an overpayment, HMRC can use all of its administration to chase that and collect that. At the point the payment was made, if it was an overpayment, it turns into tax. And there is an obligation on an employer to make sure that they notify HMRC and also correct that, repay the overpayment. There is a question of penalties. So if things have gone wrong and there is an overpayment, HMRC can charge a penalty. At the moment, employers can avoid a penalty if they do know that something is wrong. They can avoid a penalty as long as they correct that within a certain period of time. So if it's an individual who is an employer, they have until the 31st of January next year to correct and repay that. And HMRC have stated if individual employers do that by that date, there won't be a penalty. For a company, if it's a corporate employer, then the corporate entity has a year from the end of the accounting period in which the mistake was made. So within a year, if it's corrected and paid, again, there won't be any penalty. And it's always better with penalties. The same situation applies here as it does in other areas. There's always a distinction between a prompted penalty and an unprompted penalty. So if you do find yourself in a penalty position, potentially taking something to HMRC rather than waiting for them to come to you will result in a lower penalty. If an employer knew that things were wrong, knew that there was an overpayment and didn't notify and correct, HMRC will count that as deliberate and concealed automatically, even if it wasn't concealed, which can mean up to 100% penalty, which is obviously pretty significant if you've got to pay back the tax and then double that with a penalty. The other thing to bear in mind in relation to furlough, and in fact, I had a query about this yesterday from an insolvency practitioner. A small company, HMRC is challenging that they have an overpayment claim. So they have overclaimed the furlough payment to the extent of £55,000. The officers of the company want to put that company into liquidation. Obviously, if you're in that situation, you need to, and there is an insolvency event, people need to speak to an insolvency practitioner. And obviously there are mechanisms that an insolvency practitioner might seek to recover that money from the employer. But HMRC itself can move the liability from the company to the officers if it can show, in the circumstances of an insolvency or a prospective insolvency, if it can show that the officers knew at the time that there was an overclaim and they didn't correct that. So if there's knowledge from the officers, and it looks like the company is going to go pop, never mind using recourse that exists through the insolvency mechanisms, HMRC can move that liability to the officers. So leaving behind a furlough problem in a corporate by liquidation, there's a couple of different ways that it can be attacked. So people need to think about that seriously and obviously deal with that issue. You can't just walk away and leave that behind. So check, make things right within the time limits if there is a problem, and also keeping records, because the guidance changed and the way that things were claimed changed. Keeping records of what you did and why you did it and what guidance you followed is certainly very important, so that if you're ever challenged in the future, you've got a record of what you did, why you did it, and why you think is right. The final thing I want to talk about, and this is not completely new, offshore employers, pay-as-you-earn and NICs. Rules changed about 6-7 years ago to allow HMRC to recover in the UK underpaid pay-as-you-earn and NICs where you've got an offshore employer or an offshore entity. To give you an example of how this might work, if you imagine in the UK, you've got a recruitment agency. They don't employ any staff, they just place staff in the UK. Those staff all happen to be employed by a completely separate company that's based offshore. They deal with all of the payroll and the administration, et cetera, et cetera. If the offshore company makes a mistake with its payroll, underpays pay-as-you-earn and national insurance contributions, potentially HMRC can move the liability from that offshore entity to the UK. And in the example that I've just given, where you've got the offshore employer, a UK agency, and then UK end users, HMRC might be able to move the liability from the UK, from the offshore employer to the UK agent, which seems relatively unfair. The UK agent potentially has nothing to do with how the offshore entity administers the payroll, what they're doing, whether they've got things right, whether they've got things wrong, and suddenly they find themselves with somebody else's liability. To take that example slightly further, if the agency is also offshore, so you've got the employer offshore and the agency offshore, and the end clients are in the UK, again, if there is a mistake with the payroll, the end client could find themselves with HMRC approaching them and saying, well, these people offshore got it wrong, you now have the liability, which is obviously a very uncomfortable place to be for somebody finding themselves with a liability, and they had nothing to do with the maladministration or the mistake or whatever. Potentially, depending on the circumstances, if companies find themselves in that situation, they may be able to defend it. But having just working with a company that does find themselves in this situation at the moment, it's clear that the important thing is, if any UK-based entity, whether it's an agency or an end client, is using workers which are either employed or supplied from an entity offshore, due diligence into those entities and making sure they're doing things properly, doing things right, is going to be very important to make sure that you don't find yourself in that sticky situation. And also in the situation that we're in, we've gone back to look at the contracts with the offshore employer and the indemnities that were in place. And the indemnities were only in place for a very short period of time. So it's certainly worth checking indemnities because HMRC quite often takes several years to catch up with problems, to make sure that any indemnities that are in place with an offshore employer or agency in terms of them picking up the tax bill are there for a long enough period of time such that it covers you after the event. So crypto assets, usually taxable. Residential property needs to be reported within 60 days, gains on that for individuals. Furloughs, look at it correct now if there's an issue. And if you're dealing with any offshore employers, due diligence and making sure that they're doing it right is quite important.
That's great. Thank you very much, Jeremy. We have had a few questions in, so I'll just run through those. As you can probably expect, we've had a few on the notion of crypto, so I'll address those first. The question reads, what about records and crypto assets? Some old exchanges have disappeared. Some people may not have records of their buy price.
Yeah, it can happen. I think if you were buying Bitcoin 5 years ago or something like that, You may not have had a lovely exchange providing you with all the information. Keeping as much as you can is important. Looking at your bank statement, seeing if you can find out what you purchased it for, if you've got a record of that transaction. If it is, usually bank stuff is available for 6 years. So if you bought something a while ago, going back now and looking at what you did and when you did it and how much it cost is probably a worthwhile exercise. You should keep the records. If there are limited records, looking at it from other angles in terms of, you know, what footprint of the financial transaction have you got, and make sure that you keep that somewhere safe if you are going to sell in the future is important.
Thank you. And sticking with crypto, the next question is simply about, what about a loss on crypto assets?
Potentially a loss on a crypto asset, you could use that in the same way as a loss on another asset. So if you made a capital loss, Hmrc for individuals is treating it in most instances, a profit is going to be a capital gain. So a loss would be a capital loss in most instances, I would have thought, and can be used in the same way.
Great, thank you. And the final question here from Sarah. If Hmrc finds issues with furlough, will they look at other aspects of an employer?
It depends how serious the issues are. If it's a very discrete and small technical issue, the inquiry might be just constrained to that one thing. If it is a pretty serious problem with furlough and things have gone really wrong, it may well be that Hmrc takes the view that, well, if that's wrong, what else is wrong, and extends an inquiry, which is another good reason for taking things discreetly to Hmrc and saying, this was an overpayment, here we go, we've sorted it, here's the money, and try and keep that boxed up. But there's always a chance if Hmrc finds one thing wrong, they move on to something else.
That's great, thank you. Jeremy, just to finish off, I believe that we're going to be producing a guidance note following this session, which will circulate to the delegates. So for anybody else that's got other questions, that guidance note will come out and Jeremy's contact details will be on there.